Senate Higher Ed Committee. I'm going to ask Reverend Payne to have our invocation this morning. What's your mic number, Reverend Payne?
Number 9. If you please open your Bibles to...
I figured he'd pass the collection plate.
Let us pray. Heavenly Father, we come to you today, Lord, just thank you for all of our many blessings, Lord. We just ask you to keep us guided and focused in your will, and that your will be done in all things that we do. For us in Jesus' name we pray. Amen.
Amen. Okay, we have one bill before us. We had two. The author of the other bill asked that it be held for a revision, so we will only be hearing Senate Bill 333. I think a notice went out on that today. And Chairman Albers, if you'd like to go to the podium or either sit down, either way.
You know, Mr. Chairman, if you don't mind, I'm going to ask Mr. Shook to join me if we can sit down up here. That's all right.
Absolutely.
Thank you.
Tap both your mics and make sure that they're live.
Mine's on? I don't think his is. He's 3.
Try that one.
Yep.
All right.
Perfect.
Good deal.
Mr. Chairman and members of the committee, thank you for hearing Senate Bill 333 today. I want to begin by the story and events that got this legislation authored and working together with the executive director. A friend of mine who actually lives in my neighborhood, his name is Jake Lilly, owns a great small business here in Georgia. They help people to study for what's called the Project Manager PMP exam, which, yep.
How's the volume? Can everybody hear? Everybody okay in the back? Can you hear?
Okay.
Okay, go ahead.
Jake contacted me because he was identified as a business that would fall under the GNEPC guidelines, where they would have to go through an audit, pay money to do that, have to turn over all their financials, etc., which didn't make any sense to me, and neither to Jake, because he runs a small business, and all he does is help people prepare for exam. He himself is not a school. He does not offer the exam. They're really more of a tutoring service that has been successfully helping folks throughout the state of Georgia for some time. Once I learned of this, I was concerned, so I placed a call into Director Shook, and we immediately worked together, and I want to thank him personally and Governor Kemp in his office for reviewing what was put in place a very long time ago in order to protect our students from a fly-by-night type of college institution. You know, you've all probably gotten emails. Just for a few $1,000s, we can make Reverend Payne, Dr. Reverend Payne, right? Or or a fly-by-night school that started and then disappeared in the middle of the night, and those students who had paid tuition and were on a track to try and get a college degree or some type of certificate had lost that ability whatsoever. So the foundation of what Mr. Shook's organization does is great. However, what we're going to do today, with all parties working together, is slim that down. So this is going to be removing some government, and I know we all like that ability. But secondarily, we're also going to put some better protections in place and make sure that the work that we're doing from the state is being protective and complementary at the same time. So with that, Mr. Chairman, if I could indulge you, I'd like to ask Mr. Shook to help as we go through this bill and give his perspective. You'll see that there's a lot of areas that we're striking out of this and a few clarifications.
Okay.
All right. Go ahead and introduce yourself first.
I'm Kirk Shook, the Executive Director of the Non-Public Post-Secondary Education Commission. Come before this
If
committee.
you want to pull that mic a little closer, it may help.
Is that better?
That's good. Thank you.
I've come before this committee several times. We've had legislation every session that I've been the Executive Director here. And just in general, for those of you who may not have been at one of our presentations, our agency is the entity, the state agency that regulates all the private colleges in the state. And it ranges from your typical Mercers and Emorys and things like that, where we have minimal regulation, to your DeVries and Strayers that you see on television, to horseshoeing school, to a lineman school, to all kinds of different things. And so anything that's post-secondary education that is not under TCSG or USG. So that's just kind of a general premise of what our agency does. And the bill addresses some of the things as Senator Albers had mentioned, and I think that it does narrow our focus just a little bit, allow us to focus on entities we think we have a little bit where we need more focus with a small staff, a small agency. At the same time, cutting some regulations, giving businesses or these schools a little bit less burden and red tape that they have to go through, a little bit less cost, we believe, and at the same time, as Senator Albers said, offering some greater protections to students as well. So that's the general gist of what we have going on here.
And with that, I'm happy to take us through section by section if you'd like, Mr. Chairman.
Okay.
Okay. Beginning on page 2 of the bill, section 1. As we talked about earlier, this is striking a good part of the code to make sure that the activity is really focusing on that degree, certificate, or very specific things, achieving a test or a credential at the end of that, right? So you'll see the lines that are struck beginning on line 23 that takes those folks that wouldn't necessarily be covered out of there and makes that a little more open as you'll begin on line 26. Really to give the department the ability to make sure they're providing good governance and oversight, but not going down to a level they don't need to be anymore.
What is the content of paragraphs 1 and 2 that you're repealing and reserving? On line 20. That was not listed, and it's not in the bill that I can find that it's a strike through, and I have not read it. This is a hearing only, but I think I'd be interested to see what we're actually repealing when we're repealing a section.
Do we have legislative counsel in the room?
They're not in.
Oh.
They're not. No, they're not in.
All right.
I'm sorry.
We'll come back to that.
Yeah.
That's the reason we're having a hearing only.
Yeah, I hadn't noticed that section. It looks like it's relating to the definition, so I can go and check and have that for you next week.
Okay.
Okay, I'll continue to move on unless you stop me, Mr. Chairman, or for committee. Section 2, as you can see by new additions on line 34, sole discretion for not granting degrees as opposed to not granting degrees. Again, the discretion back to the department level to make sure that they can look at things from a wise perspective and not automatically rule somebody in or out. Pretty straightforward on section 2. Now I'm going to keep going to section 3. I'm sorry?
So what's the impact of line 36 and 37 then?
So this
Repeat that, if you
is,
would, into the
Oh, I
microphone,
apologize,
so we can
Mr.
get it
Chair.
in the record.
I'm saying, what is the impact of 36 and 37?
it
The new language.
Yeah, it narrows the focus a little bit here, and specifically for, in this section 2, deals with those types of entities like, Microsoft Word, Excel, project management, things like that. If a entity is providing training that is overseen by another entity, it's what we call in our office a box program. So it means they just take whatever the industry gives them and then applies that to them. It just takes our regulatory authority out of that because they already have to abide by industry standards, and we don't have to have oversight of that.
Yep, understood. Mhm.
Yep.
Thank you.
Mhm.
Okay. Section 3, you want to talk about the permits for us, Kirk?
Yeah, so in section 3, this broadens it out just a little bit. One of the things in all of the sections 3 through, I think all the way up through 15, in all of these sections, it is taking out agent permits. That is one of the things that was put into place in the 1990s when this code was written. It was something that a lot of states had in place. as a way to provide protections to students so that you didn't have folks out there claiming that they are representing an institution and they're really not. So if there were recruiters out there, they had to be permitted through the agency. We feel like that this part of the code is not as necessary anymore because folks can look people up online, things you couldn't really do in 1991 when the code was written. It's an additional layer that institutions have to submit to us as far as documentation, applications, all of that, and then at the same time, our agency has to oversee and approve and go through that process. So we feel like that this is something that is not really necessary anymore. We still have protections for students in our code and what is our minimum standards that allow for students to be able to make complaints or us to be able to raise litigation against an institution if they have folks that are acting inappropriately. We have a good moral code character or moral character clause in our code that offers those protections that these agent permits do not. Since I've been here, and at least through the previous two executive directors before me, never once had they revoked an agent permit, had ever really done anything with that. So we just felt like it was duplicative and something that could be removed that could help not only our staff be able to do their day-to-day work a little bit more efficiently, but we didn't feel like that schools necessarily needed to submit this every year for approval when we weren't doing anything with that anyways.
Okay, I'll keep going. Moving to section 4, this is a little bit of cleanup, honestly. Just rather than calling out minimum standards, it is just these are the standards. Pretty straightforward stuff and renumbering. Again, you're going to see the crossing out and removal of the agent stuff. That's consistent throughout the bill, so I won't necessarily go through each one of those that are struck.
On line 125, shouldn't that be, shall require the following standards? Should you not leave in following and standards?
I think that down below that, Mr. Chairman, if you look at the paragraph below that, I think they've kind of reworded that there. Because I don't know what precipitated that, but when they got our code, this is what they gave us back and felt it was better. Yeah. But they didn't change any of the content of this section. It was a renumbering.
I just like the fact that it stated that it is a standard, not a suggestion.
Right, yes.
Well, I think if you go down to line 128, because
It
they
does,
struck
yes.
that, it just continues that paragraph from 124, where
Mhm.
and striking or require just continues going. It says standards at the very end of line 128.
Okay.
Okay, I'll continue to section 5. Again, we're striking stuff. This is related to the bonding part. I'm going to ask Mr. Shook to talk about this, where we found an issue to improve, I think, upon the way we're doing stuff with bonding. So why don't you share that, please?
You will get into it more specifically when we get to section 16 because that's a major change to our code. But currently, entities, all institutions for the first 5 years of their existence must pay into a surety bond.
What line are you on?
We're beginning on line 223, but it's going to be talked about further throughout the bill. But we
And-
start talking about bonds here, so we wanted to lay the foundation for you.
Okay.
That's right. And you'll see it mentioned in section 8 and then again in section 16. But each institution has to have a bond in place for 5 years, first 5 years of existence. That's going to be coming out, and when we get section 16, I'll tell you what's going to replace that, unless you want to jump to that.
All right, continuing through section 5, again, striking agent, things of that nature. It's the same consistency throughout the bill. There were just different areas that we had to strike it to be consistent. This is why this bill looks big in volume of paper. It's actually not that much change that you might think. So we're continuing now. We'll get to section 6, which is begins on line 275. And this is where we are also making references to the changes that happen later in the bill under bonds. You'll see that a little bit later. I'm going to keep going unless said otherwise. We're going to go to section 9 again, getting rid of permits. Same thing as before. All very consistent here. Section 11, same thing. It's all the permits. Section 12, it's the same thing again. A lot of duplication here, I'm sorry, we had to just clean up the whole code when we did it. Section 14 and section 15, but now we're gonna get to one of the meat part of the bills, which we wanna spend some time talking about, which is section 16 in relation to the way we do bonds. And I'll turn it back over to Mr. Shook, if you don't mind, Mr. Chairman.
I'll give you just a brief overview of this, and as you're looking at the code, if you have any specific questions, we can answer that. As I mentioned just a second ago, each of the institutions currently has to have a bond for the first 5 years. They also pay into our TGTF, our Tuition Guarantee Trust Fund, for 5 years. This is a fund which the agency manages and operates, but it is the fund which allows students that if a institution closes precipitously and the institution does not fulfill its obligation to the students in some form or fashion, most recent here in the state was in March 19 when Argosy University closed. They closed in the middle of the semester, locked the doors, students couldn't finish out their term. We use this Tuition Guarantee Trust Fund as a way to help to make the students whole that had prepaid their tuition for the semester out of pocket. So that's what that TGTF is there for. So the purpose of this code section is to, as the Senator mentioned, to remove the bonding requirement so the institution no longer have to pay into the bond for 5 years, but instead will pay into the TGTF instead of for 5 years, for 7 years. And basically what we're trying to set up is a self-insurance model here at the state. And I'll give you a reason why I think that that's important. To go back to the Argosy example in March of 19, when they closed in March of 19, we went through the claims process. The students had them provide documentation and those things. Within a matter of about a month, we were able to start issuing checks to students to be able to make them whole so they could go on to the next institution and continue their education. The institution also, because they had just gone through a change of ownership process, the school, by the way, had been in place since the agency was founded. They had permit number 26. So they were 26th institution we had. So they'd been around a long time, but they had fulfilled bonding requirements, all those things, but they had a change of ownership 2 years before they closed. Had to get a bond according to our code for another 5 years. They had 2 bonds because they had 2 campuses, an online campus and an Atlanta campus on ground. Both closed, $200,000 bonds apiece. We asked the surety, the insurance company, to remit those bonds to us as is required. And it took us over a year to get that bond money from them because, of course, an insurance company is the one that operates this. Any of you dealt with insurance? No, they don't ever want to pay out. So this is a way for us to try to bring all that in-house as a way to, instead of waiting what became over a year and a half to pay out the students from the bond that was there, to be able to do that from our fund. And we feel like that this is something that it will greatly help our students and give us the flexibility with our fund that we don't currently have. So, and currently we have about $4.5 million in the fund. We don't, in the past 10 years, there have only been 3 institutions, I believe, that we've had payouts from. There's protections within this code sections that, won't, number one, force us to have to make certain payouts. It puts in the commission, my commissioners, the ability for them to determine what we pay out for that. We did that with the bonds for Argosy back in 2019. So we'll never be on the hook for something but, a huge payout. And it also has protections that it can only be, I believe, in here, I'd have to go back and look, but I think it's 10%. You can't, one institution can't claim more than 10% of the fund total, whatever that is. So $4 million, it'd be only $450,000 that can be taken out of that as it currently stands. So those are the protections that adds in, gives flexibility, and I believe, and in addition, as we talked about the agent permits being a burden on the agency and the institution, the bonds are as well. Institutions have to go out and find an insurance company to underwrite a bond for them. They have to do this annually, and then we have to approve or get those bonds in place. And a lot of times, what I've been told by staff is that that bond is that final piece before an entity can become authorized, and it oftentimes is the linchpin. And it takes several more weeks or even months for the institution to start operating the state because just the paperwork process. Whereas our Tuition Guarantee Trust Fund, they give us the check, they give us the money, they can start operating that same day. So it just reduces regulations on the institutions and at the same time adds in protections at the same time. So it's a good balance, I believe.
Okay, and I'm sure there'll be a lot of questions. Yeah, are you done?
Yes.
Okay. You're 8? Okay.
I'd just like to know, how do you compute that number that they write the check for?
It's, so I'll just give you what we did there in my first year when
Thank you.
when Argosy closed. We'll have a claim period for the students. So we'll get all the student information at closure from the institution or whatever. We went and were able to pull the 1,500 students' information, contact them via email, sent letters to them. And we said, we're going to have this claim period that's opened up for this amount of time. We sent a survey out to them via the email. Same thing, sent the letter and had the survey link in the letter that they could go to online. We gave them a certain amount of time to do that. When they filed the claims, then we would cull out what was legitimate claims and what wasn't. And then we had a staff member that was dedicated to this, and she contacted each person, and I think we used an online portal for them to be able to submit securely their documentation to show that, yes, I paid $4,000 this semester. Here is my receipt or my ledger card, whatever I have to be able to prove that. If the students could not provide that, and there were several that we ran into, we couldn't substantiate the claim, so that claim was called out. So it was only those that we could verify. And so we went through that process both with the TGTF in 2019 and then 2020 when we finally got the bond payout. We went through that claim again for the bond. Because what the code says, just so you guys know, the current code is very limited in what the tuition guarantee trust fund can be used for. It's only one thing. That's unearned tuition, meaning that if I prepaid tuition, they didn't fulfill obligations, we can only reimburse for that. The bond allowed us to be able to expand that a bit more, that if there were other cost associated books or whatever else we deemed appropriate, we had about 6 items we could pay out of that. And so what this code does is opens the TGTF up a little bit and allows us to be able to use it for more things than that. So essentially treat it like we treated the bond, with still, again, the same protections and those things against the fund, so it isn't rated.
So how much did the school have to put in initially?
It's all dependent upon the size of the school. So currently, schools pay in 1/10 of 1% of their total tuition or projected tuition. So
Going forward too?
that's right. And so larger schools will pay a larger amount. Smaller schools will pay a smaller amount. And so, again, as I said, they currently pay 5 years. This will extend it out to 7 years. So it'll pad the fund just a little bit and allow us to be able to open up when precipitous closures happen. Although, I should mention, we have closures all the time, but most of them are not precipitous. Just this last quarter, I think we had 6 schools close, but all of them were able to teach out their students or find other things for them so there would be no claims on the fund in that event. It's only if they close with no notice. And as I said, in the past 10 years, I think only 3 schools have done that. Argosy in 2019, Virginia College in 2018, and ITT Tech, I think 2013. But in the last 10 years, those are the only 3 that have
So
claims.
even the bigger schools like Liberty University, some of those, they still have to do the bond?
No, well, not if this bill
Not
passes.
bond, but put the money in?
Yes, they would have to pay that for the 7 years. One thing that we have added in here is there's a grandfather clause. So, for example, DeVry and Strayer have been here for a long time. They've had a lot of campuses. If they've satisfied the current code requirements, 5 years of a bond and 5 years of TGTF payments, they'll be grandfathered in. They don't have to pay those 2 additional years. So it'll only be for those schools that currently have not satisfied the requirements, or new schools that come in, and which we have new schools come in every year. I think last year we had 49 new schools come in.
Wow.
And we're on track to have about 60 this year, so.
Thank you. Thank you.
Well, our CPA over here got 3 of my 4 questions, I think. So we were on the same page of that. So, I mean, basically, you get your tuition back. You don't get your life back from the wasted months, but
That's right.
That's all you can do. I understand that. And now, those that quit paying in fees, they still would be covered if they shut down.
Correct.
I thought I understood that. And then the last question I've got is, when you're starting this out doing 1/10 of 1%, if a couple of things happen, are you not going to have the money there to you know, starting out? Do you have to build the fund up, or how's this gonna work?
Well, the fund has been in place since the agency began, and so currently we have $4.5 million in the fund. And it grows every year, you know, several hundred thousand on average. Currently, even the way that we currently have it, in adding 2 additional years on the school will cause it to grow a little bit quicker, but at the same time, the trade-off is that we're opening up the fund to be used for more things than it currently is.
So the surety companies haven't been getting all the money. You guys have had a fund besides
That's
that?
right. So there's been a dual thing going on. Sureties, insurance companies have been paid through the bond, in which almost all of them, by the way, we've had about 300 institutions bonded currently this last fiscal year. All but 6 paid out of state, so that's money leaving the state, which could have been going into our fund here. So it's also, you know, Georgia protections as well. So they're currently having to do both things. With this new language, if it passes, it would just be the fund that they would pay into, which we would manage and be able to not have to worry about going to litigation like we did last time to try to get the funds.
All right, that answers my question, Joe.
Any other questions? Senator, are you number 12, Senator? 11.
Yeah, Mr. Shook, a couple of things. In terms of the bond requirement, you indicated you were able to use the bond money in terms of Argosy to cover other things outside of just kind of the unearned tuition credit. And you indicated that with the new language, even though you're doing away with the bond requirement, the new language is going to allow y'all to use the fund money to be able to kind of do more than just the tuition.
Yes, I don't know exactly what line it is here, but basically what it says is that it's going to put into the hands of our commission the ability for them to determine what we pay out on, which is currently, in the current language, it says explicitly you can only pay out for these things. So basically we're opening it up and allowing for us to be able to use the fund like a bond would be used for if in the event of a precipitous closure.
And with respect to Argosy, how much was paid out of the fund?
There was $60,000 or $61,000 paid out of the fund because it was, you know, again, just for the unearned tuition. That's all we could verify. And then we had about, I think it was $253,000 that was paid for out of the bonds that were there. Because again, we could open up to more things. So in total, let's say that, you know, we have the same parameters and this law were in place, it would have been in the neighborhood of about $310,000 that we would have paid out of the fund, given the same parameters right here. So,
And if a student is able to get some money back from the fund or whatever, however y'all do it when one of these institutions closes, that doesn't impact their ability to then like go directly after like Argosy. Okay.
No, ma'am. And I don't know all the federal rules with this because that's the thing when you're dealing with these institutions. You have federal regulations, state regulations, all that. I think there's a caveat if it's a federal loan and they get, you can either have a federal loan disbursement, which then means you can't go to another institution, but with us paying out of this, it didn't prevent them from being able to go somewhere else. We were also, I should say this too, and it just shows you what we try to do as an institution or as an agency. At the time that this closure happened, we tried to partner with a bunch of other both in-state institutions and out-of-state institutions as a landing place for these students so that, you know, they could go somewhere else and fulfill their education and not just, you know, take a payout and then, as Senator Huffstetler said, you've wasted all that time. So we had a list of, I think, about 35 institutions, both in-state and out, that was willing to accept Argosy students, and I know some did. There was a couple from California that we gave immediate authorization to be able to start teaching out some of these students. So we try to match up these students.
If I could, if I hear you right, I think what Chairwoman Jordan is asking is, can they also seek damages outside of that? Could they sue the school? The answer is they absolutely can if they think that they need further damages. That will be their prerogative.
And for the good of the order, the two things that are deleted are just the definitions for agent and agent's permit. And since it's being stricken throughout the code, then that makes sense then to take them out.
Thank you.
I have a quick question.
Senator Ward?
Thank you, Mr. Chair. The question I had is, in terms of this, a hapless student enrolls and pays their money in good faith and is working away, and this blow-up happens like with Argosy. that had a long reputation and history. You wouldn't necessarily expect it. What are students in any way forewarned to keep a bunch of records in the event that this happens? And I wondered what percentage, what was the turn down percentage of students who didn't qualify, whose documentation was considered inadequate or missing, or for whatever reason? What percentage of your applicants for funding didn't get funded, and is that something that's a cause for concern, or how can we do a better job of equipping students to know?
Yeah, good question. To answer the first part, I'm pretty sure, and again, the staff that does this day to day can answer correctly, but I'm pretty sure that in the enrollment agreement that we have the students have to sign, that has to be kept on record with the institution, that those type of things about record keeping and things are part of that. If it's not, there's of course something that our staff could add and require institutions to make sure they have something that the students sign off on, that they know this. Now, we've all had things, and especially on our iPhones and those things, it says, got to read all this stuff and click accept. There's some of that stuff that happens, and so I don't know how to get around that part. So that is something, though, that we could try to strengthen more for the institutions to put on the front end, to be able to say in your catalogs, enrollment agreements, and those things, make sure that it's noted. Keep any of your ledger cards and records of payments and things like that for that. As far as the turn down rate for that, it's hard to say off the top of my head, but I believe out of the 1,500 students that we sent information to, about 500, and again, I'm just ballparking this, but about 500 submitted and said, I have claims for X, Y, and Z. About 20% of them or so we were able to fulfill. Now, it doesn't mean that all of them were turned down just because of lack of records. A good chunk were. They couldn't provide us with information that, hey, I did pay out this thing. But some of them submitted claims for things that we didn't cover. I'll give you one example that I can remember off the top of my head. Somebody said that because the closure, it was so traumatic to him or her, I don't know who it was, the student, that they had to go into therapy, and there was $5,000 in therapy bills or something like that. We didn't deem that as something that could be, in talking with council, that we could tie directly into the closure. There could be all kinds of other extraneous things. So that was something that we didn't include as part of that. So there were claims for things like that we did not even ask for documentation because we didn't think that was valid. So it's hard to say on that. As far as just the documentation, probably, 60% plus didn't have the documentation that we needed, or couldn't provide anything. They would say this is the amount, and when we would follow up, and our staff member followed up several times, we'd get crickets and not hear anything from anybody.
So a third of the students of the 1,500 responded with some effort to get some reimbursement, and you say 20% of those actually were successful. So
that's right. It's about 100 is what we ended up paying out, either from the fund or from the bond. So there were still a lot that were out there that didn't. But if the student, was able to carry on their education somewhere else, that wouldn't be part of that. If they got their federal loan dispersed, that they wouldn't have been able to make a claim. So there's several other things those other students could have taken avenues that necessarily they wouldn't want to seek reimbursement. So. But it's certainly hard to tell. But thankfully, those closures are seemingly few and far between. There's not a whole lot.
Sure. Well, it might be worth looking at some requirements or stipulation with the institutions that that information is provided to the students. And like you say, people don't read everything they sign, so on and so forth. Lead a horse to water.
Right. Yeah, no, that's a good idea, and I'll make sure, and it may already be there, so I can't tell you for sure, but I'll go back and ask staff, and they'll be able to tell me.
Thank you.
It's an easy admin change that we could make if we would like to do that, so good suggestion.
When was the Tuition Guarantee Trust Fund originated? Was it in the original bill?
Yes, and I don't, now just so you know, the INPEC was created in 91, the agency started in 92, but the responsibilities were housed at the Department of Education before that. I don't know if they had a fund at DOE or not, but I know that a fund was created with this language when the agency started in 1992, and institutions began paying into that over the years.
And what is that amount? What percent of 1%?
1/10 of 1% of their projected or actual tuition. So for a new school, they would project out how much tuition they think they're going to have in their first year. For schools that are already operating, we would take whatever tuition number they're reporting, which for some institutions is quite a lot. Like, for example, American Intercontinental University is, over the last several years that I've been here, they've been the #1 school in terms of tuition that they brought in, which has been like $200 million. In total, just so you know, all of our institutions combined, just our authorized institutions, it's not including the Emorys and Mercers and things like that, just the ones that we go out and regulate on a day-to-day basis. Each of the years that I've been here, and today was, I started year 3, $1 billion a year is what it adds up to, and of what is paid into these institutions. And so,
Do y'all ever audit those records?
The big numbers, where they come from, most of them they're reported to accreditors and those type things, so we feel confident in that. For smaller institutions, a mom and pop organization that's, running 12 phlebotomy students a year, we go on whatever they based on. We know what they said they charge in tuition, and we say they have this number of students, so the tuition should match whatever they're saying they're having in students. So there's a discrepancy. We have 2 financial folks that oversee that and help try to make sure that things make sense, but we don't go into their books. It's self-reporting.
I'm sure y'all have electronic data on what they're being paid out on, how many students, and it looks to me like that would be pretty easy to track, just to keep them honest.
Right. And I think a lot of it is, and because I said we do have 2 financial auditors, one that deals with accredited schools, one unaccredited, but I think like the IRS, just because there's a threat there, it seems to keep most people honest. And, we have a few every year that I have to come in on and they ask questions about, but just that will usually get them, and they'll say, oh yeah, we misreported, or we can require them if we think something is amiss, or if they continually have issues, we can require a CPA audit or review. So all of that is within our current code section, that under the financials, if we think there's something missing or something going on, that we have that ability. But it's not the first hammer that we strike.
All right, let me get this straight now. Currently, they have to be bonded for 5 years?
5 years, correct.
And they also have to pay into the tuition trust fund?
Correct.
So we're looking at extending it to 7 years, correct? Now, you said, when you say extending it from 5 to 7, so everybody goes to 7. It's not negotiable whether it's going to be 5.5 or 7. So
Correct.
Everybody goes to 7 years.
Unless
Okay.
they've already fulfilled the obligation, which this new section allows them to be
Okay.
grandfathered in. But any currently paying in will have to pay
All
to
right.
7 now.
Now, how long has Argosy been in business?
Well, before they were permitted here, I don't know. But as I said, they were in business since, I think, in 1992. They were first authorized here, so they were permit number 26.
Well, how were they paid? I mean, how did a bond fund cover their liability if they're not required to have a bond?
Because they satisfied their bond requirement in the 1990s, but they had a change of ownership. Argosy sold to Dream Center in 2016 or 17. The code language currently says, when talking about bonds, that in the event of a change of ownership, they have to start paying into a bond again. Also, if you look at line 466 on the bill, we've added in part of this here as well, where we can determine for that institution they may have to go back and pay into the TGTF for up to 7 more years with a change of ownership, depending on certain criteria. We haven't set those, but it gives it the discretion of the executive director to determine if that institution will have to pay in again if they change ownership. So if there's something substantive.
Have you done a statistical analysis over the last 10 years? If this had been in place for the last 10 years, where would we be from a cash standpoint, and if we had done away with it and instituted it 10 years ago?
Yeah, we haven't gone back that far to look at that, but the cash flow into our fund would increase maybe 20% is what I'm estimating. It could have been more, so at 4.5 million, so it'd probably be $5.5 to $6 million instead of currently where we are at $4.5 million. So we'd be in a better fund shape. But as I mentioned, as far as payouts, we've only had 3 in the last 10 years from the funds, and those have totaled in those 10 years around 500,000, 600,000. Argosy was the biggest one. So it's,
Of the institutions that no longer exist, how many of them were past their bonding period?
I'd have to go back and look. We have closures and new schools all the time. Just this last quarter, we reported to our commission last week that we had 19 new institutions, all of them which start bonding, all those things, and 6 closures. And that's pretty typical that we have, 10 or 12 new institutions every quarter, 5 or 6 close. And a lot of them are smaller institutions, again, running 5 or 6 students a year, not a whole big chunk of students, and so it just becomes something they can't sustain for one reason or another. And again, all of them we have in place if we know that a school is looking to close, say somebody's coming to retirement or they're looking to get out of it. Our regulatory staff work with them to make sure they have in place a teach-out plan to be able to send their students somewhere else if they close in the middle of doing this. But most institutions, if they close, are going to say, okay, I'm going to close on this date, and we're going to make sure that we take care of all the students up to that date. We won't enroll anymore. And so we see that, again, over the last 3 years that I've been here, there have been about 60 or 70 closures, and only one of those was a precipitous closure, Argosy. The rest all were closed in a time and manner that they were able to satisfy the obligation to all students. We have one coming up in the next couple months, I believe, DeVry, Henry County's campus. They're closing that campus, but what they're doing is they're sending all of their students to their online campus or another regional campus they have. So a lot of the institutions try to go ahead and take care of it when they're doing that, particularly the large institutions.
I'd say this in terms of when you look at the failure rate of startup companies right now, I think 45% of them fail within 5 years. That concerns me. And I'll say this just as an overriding principle. I'm a whole lot more concerned about protecting the students' interest than I am the institution's interest. I've been in business a long time, and I've had to still post payment and performance bonds ever since I've been in business on every contract I do that's a public contract.
Right.
And I will say this, one thing about bonds that make people sit up and take notice, and one reason that Argosy may have, their bonding company stepped up, was because on bonds, typically speaking, you have personal indemnity of the principals. And when you've got the principal in a corporation that puts their name on the line, it makes a difference on your willingness to satisfy any claims that come up. So I'm not absolutely sold. I mean, the bigger issue to me is the distinction between, you said y'all paid out on the unearned tuition. What concerns me about these private institutions that go out is the tuition that's been earned, but you have credits that are non-transferable. So that's a huge loss to those students. It's not just what's lost in that semester or that quarter. You think about how much they've put into that.
Right.
I think we ought to have a percentage of reimbursement funding. It can be just like a risk ratio in insurance. But I think if an institution fails and somebody's in the 3rd year and their credits are non-transferable,
What a blow.
I mean, that is a huge loss, but the difference in unearned tuition and lost credits that are non-transferable is huge. We need to protect the student's interest. I mean, I had a member of my family, extended family, that has gone through this very same thing. They basically lost every credit they had, and because it was non-certified and it was non-transferable.
Well, and that's something with this, if this were a route that we want to go with the opening up of the code, we could potentially do that if a student could not transfer or something else. I'd be a little bit nervous about it because would there be a run and rate on the fund potentially? But no, you're exactly right, and that's why we as an agency tried to pair up students with like I said, I think there was about 35 institutions that were willing to accept Argosy students to be able to come and finish out their degrees. Now, how much of the credits transferred, I don't know 100%, but I know that there were a lot of institutions that were stepping up to try to bring on the students and accept as many credits as they could. So we tried to do that, and we felt that was important on our part to do. I don't know if other states try to do that or not, but I know that we did. We were able, I know, to be able to match up a good chunk of students with new institutions.
Well, I'm more for protecting the students than I am the institutions, because the students' time, the students' money, if they have non-transferable credits, that's a huge loss, both in time and in money. So
Right.
I think this is going to warrant a whole lot more looking than a cursory look at it. And I appreciate bringing it. I think we ought to cut out unneeded regulation, but I think we need to have the security, the financial security, because we have people coming into the state all the time wanting to get approved. And the failure rates are huge for startup businesses.
Right.
And, you know, we're basically taking over the fund, we're taking over the function of the bonding companies.
Correct.
There may be a reason these institutions are having a hard time getting bonding, because they may not have the financial resources to back up the claims behind it. And if we let them out from under that, you can always have a civil suit. But if they're based in another state, you've got to do it in federal court, because you can't get jurisdiction on it. So all I'll say is, I'm open to looking at it, but I want to protect students.
Mr. Chairman, if I could, I think you're bringing up a good point about the bonds. As Director Shook said, out of the 300 or so that have them, only 6 are in Georgia that are getting their bonds from. So those other 294 are getting from bonds from out of state. So God forbid there is a problem and the bond company doesn't want to pay, or it becomes a bigger issue, then you create, in this case, a long drawn out battle, and then it goes, how much money do we spend to try and get the money they were supposed to get to begin with? So using what I would call more of a self-insured model at this point is, the schools still have to pay. They're really going to pay about the same they would in a bond anyway, only now we know that it is in the place where it can best be deployed to the student.
Well, my concern is who's going to be vetting them. If we're going to take over the bonding mechanism, we need to vet it at least on the same level the bonding companies do, and that is very stringent. I've been through that. I still go through it every year. I have to give them a certified statement. But it concerns me when we're dealing with out-of-state companies. If we don't have a pre-qualification of the bonding company and a rating of the bonding companies, it doesn't matter to me that we have a bond. If they're a C-rated bonding company, you don't have anything anyway. You're probably not going to collect from them, or you're going to be they're going to carry in litigation long enough to burn more money than what you get out of them. So there's a lot about this I think we can look at, and I appreciate you bringing the bill. We'll have some more conversations on
Thank you,
this.
Mr. Chairman.
Thank you.
One more question.
Yes, sir.
You said it was $1 billion in charges, and so if my math's right, 1/10 1% would be like $1 million, but not everybody pays into it.
Correct.
So what do you anticipate getting per year?
Well, currently the increase per year is averaging about $300,000 to $400,000 a year in terms of what is currently happening with our funds. So you think of the 1/10 of 1% of how much of the schools pay into that now. It's what, 60% of that or 40% of that. So we're anticipating to see an additional probably $200,000 over the course of those 2 years.
Per
I would
year.
think, yeah.
Okay.
Mr. Chairman, just one more brief question. You know, in light of the remarks of the chairman about the concern for the students, it concerns me. I know all these young people that pay these outrageous tuition fees, and they could be over here at our state technical colleges with Hope grants, and we're not going to fold overnight and head out of town. And there's clearly a lot of money that these private institutions are making. They wouldn't be pushing each other out of the way to get here. But how we can best serve our students and address this incredible workforce shortage that is highly documented. The Chamber of Commerce is being at the head of the class on documenting the workforce shortages. It just seems like we've got a model going here that's not serving the best interests of our economy, of the workforce, and certainly of the students, and that this is an opportunity for us to really look, take a closer look at the totality of the situation and where our public institutions come into play for these students who are out here spending ungodly amounts of money on oftentimes a very dubious certification.
Well, I'll say two things on that. One, of course, they do have more funds so they can advertise more than your TCSGs and those folks do. So they're out there more. But I'll also say this too. For the most part, most of our institutions are workforce development focused. Like they are, we're going to come in here and we're going to teach you this skill, welding, phlebotomy, whatever, and we're going to do this in a short amount of time to get you out in the workforce quickly. And so they meet a need in the market that sometimes is not there. Give you an example. Where I live in Athens, there was a welding school that started a couple years ago, and I went to go see, what you got going on here, because I'm very interested in this. And a person who was consulting with the guy that opened the school used to teach welding at Athens Tech. And so I asked him about this. So why wouldn't somebody go to TCSG? It's basically free for somebody that wants to go over there.
Right.
And so the way he explained it to me, which I thought made a lot of sense, he said, if you go to Athens Tech, you're going through these programs, you got to get your math, your English, and all that. You got your prerequisites, and you go through all these welding classes, and basically you'll have a PhD in welding in 2 years when you're done. But you come to us, and within 2 months, we can teach you how to lay a bead, and then you can go and start at Caterpillar down the road and start making $20 an hour, which is, I think, for a lot of folks, what they want to do. They don't want the opportunity cost of having to wait 2 years to be able to get into a job that I can start making $20 an hour in a month or 2 months or whatever it is. And so I thought that was a good way to kind of frame the need that a lot of our schools meet versus what's happens in the public sector. Since they are private institutions, they are meeting the demands of the public. Same thing. Give you another example. Several years ago, I was looking at getting a degree at the University of Georgia, and I asked them if they had any of the classes online. They said, no, of course not. We want face-to-face because this is, the University of Georgia, and that's how you're going to learn best. I'm currently in a degree there now, and we have a couple online classes. But a lot of the universities that we, Strayers and DeVries and things like that, have all online degrees. And a lot of folks attend that because it meets their lifestyles. Most of the students who are in our schools are non-traditional students. They're older, meaning over the age of 26. They have a family. They are folks that are looking to try to better themselves from where they are. And sometimes I think, they are, kind of led down a primrose path and probably do not get the things out of it that they may have been promised in the beginning. I think for the most part, most of our institutions, all the ones that I have gone to see, small institutions, are really trying to help folks in their community because, hey, I used to do this thing. I used to be a welder. I used to be a phlebotomist, and I want people in my community to be able to do this because we know we have a need there. And so they're meeting it. It's just in a different model than I think what our publics are doing. And I think, to be frank, I think our publics could probably look at some of the things they're doing and say, hey, these are innovative ways that we could change the way that we're doing things. So I don't want just to say that all of this is bad and doom and gloom. There are some good things going on in our state for sure.
Thank you. Go ahead. I was just thanking you.
Just to clarify, currently, an institution that comes to Georgia, the new 60, let's just pick the new 60, they would have both a bond and also play into the trust, tuition guarantee trust fund. Is that correct?
Not
Right,
as fast as
right now, but not if this passed, yes.
Right now, they pay into both, but
Correct.
not if this passes.
Correct.
And if this were to be adopted, then they would only pay into the trust fund, but they would pay into the trust fund for 7, not 5 years.
Correct.
Okay, can you tell me the difference in the cost to the providing institution? What is the cost of the bond versus the cost to the trust fund? Are they equivalent?
It's hard to tell, and the reason being is because they're entering into these contracts with the sureties that are private contracts. We're not privy to what they're paying. But in anecdotal evidence of talking to our institutions and the majority of our institutions that pay in are relatively small. The lowest level bonding we have now is $20,000 that every institution has to maintain at least that. And then if they have more tuition, they have to have higher ones on up to $450,000. But most of our institutions are at the lowest bond level, and they pay in at the lowest TGTF level. From talking with those institutions and principals there, most say it's about $200 to $300 that they're paying to get that $20,000 bond a year, and they're paying in $100 into the TGTF. And so over the course of the 7 years in the TGTF versus paying the dual 5 years of both, they would save $700-800 probably on average. So it would be something that would, for most of the institutions, I would think probably be a money saver. At the same time, they would be paying more into this fund that we're accumulating every year.
Do you feel that the higher risk are these new institutions, or the higher risk the more
I
institutions?
don't think so. And again, we've tried to put in some protections that allow for to make sure that if they are operating that, you know, as I said, we have an external auditor that reviews finances and those things. So we try to review that on the front end. We work with them to make sure that their programs are in good shape so that if they are providing education, that it's something that is good for the students and they'll be able to use that. And all of those those initial things that we do with initial applicants is what they're called, are all things a way that kind of weeds folks out, because if they can't meet the standards there in the beginning, they're not going to become an institution to begin with. And if they do become authorized, the 60 that we're thinking we're going to have this year in total is going to be in a better shape than I think institutions would have been that came in 5 or 6 years ago before, because we tried to put an emphasis on the front end. What can we do to make things better and better for the students? And so I feel like that it's not going to be as big of a risk, because as I said, just this last quarter we had 19 new institutions, but we had 6 closed. None of those 6 would make a claim on the tuition on the TGTF, and out of the 60 some that have closed, only 1 did in the last 3 years.
One more question to follow up, Mr. Chairman. One of the things I'm hearing is the challenge, part of the problem with the bonding is it's out-of-state bonding. And we get a lot of bonds that are coming from out-of-state. Is there a potential for shifting those bonding resources or sources back to Georgia, where number one, the funding stays here, and number two, it's a bit more reasonable for us to deal with?
Could, maybe, but I don't know, again, because I'm not in the business of what they're doing. I don't know how much.
I'm sure there are bonding companies in Georgia. It's just that.
And there are.
Yeah. Just a question.
That's a great point. One other question. On the Guarantee Trust Fund, do we have excess limit coverage that's underwritten by an insurer? Do we cover a single loss or aggregate losses up to a certain point, and then do we have excess coverage over that?
No, our fund is all just what's there, and it's what is accumulated over the years. The only protections we have currently in law and what will be in law if this were to pass are the limits on what each institution can pay out. Currently, it's either $200,000 or $250,000 that is the claim per institution. So it's written in code now, I think $250,000, that a institution cannot have more of a claim than that. That's the max payout we have. For this, it took away the $250,000, but it still has the cap on the total amount of the fund, 10%.
But that really hurts the students, though, right? Because you limit how much you're paying out. So if you have a huge loss,
Right.
then the students may not get full reimbursement.
And that's what I think now with the current code, it adds, well, currently we're at 4.5 million. So that 10% would mean it would jump from $250,000 where it is currently to $450,000. So we would see an automatic increase in that, and that number would increase, well, basically every month as institutions pay in. So,
If you have the record on it before our next meeting, I would like to see some statistics on the credit hour loss that the students had, not the unearned tuition loss, but the credit hour loss that the people in Argosy suffered.
Okay.
We're out of time and the meeting stands adjourned.
thank y'all.
We ran this
Can you tell me your name again?
to the wall, didn't we?
Sure.